Welcome to the very first episode of Friends with Franklin. I'm Jay Franklin Lloyd with Exit Realty Redefined, and this series is designed to introduce you to the trusted professionals who help make the buying and selling home processes easier to understand. Today, we're talking mortgages. Specifically, we're speaking of clearing up some of the biggest misconceptions surrounding financing. Joining me today is VP of Mortgages, lender Tina Apicola, or should I say the VIP of mortgage lending. Tina, what brings you here today?
Well, thank you so much for allowing me to be your first guest on your show and your segment. I love it. Obviously, as you know, I love to squash misinformation, and unfortunately, there is just way too much of it out there. So I'm here to help your clients and friends and family understand what some of those misconceptions are.
Awesome. So let's get to those misconceptions. How long does the pre-approval process normally take?
So great question. Typically, it's not a long time, depending on the person's situation. So if you have a straightforward W-2 employee, they provided their W-2s, their pay stubs, their bank statements, we could typically have a pre-approval. If they applied that day, we had the opportunity to review, go over numbers, we could give it to them very quickly, same day. Someone who has a little bit more of a unique situation, maybe they're self-employed, we have to look at their tax returns, we have to establish certain income. There might be people who are paid uniquely, commissions, things like that. Again, the devil's in the details. So those could take a little bit longer. Typically shouldn't be more than a couple days, but again, you also need the participation of not only the buyers, but in some cases, we also need their employer to help as well. We've had instances where employers could take a week to get us back a verification of employment. I can't give you a pre-approval until I know that your employer verifies what I need. At least not me. I won't do that. Others might. I will not.
And that's the beautiful thing about you, Tina, because the devil's in the details.
Yes.
Does getting a pre-approval lock someone in with that lender, or are they free to visit any other lender?
Great question. You always have the ability to shop for lenders. Here's the one thing that's a misconception, though. If you're in the pre-approval stage and you're just calling around to get interest rates, those interest rates don't mean anything because you don't have a sales contract. The interest rates are not tied to the buyer, they're tied to the property that you're purchasing. So for example, if you called me today and asked me to give you a quote, and I give you a quote today, but you go under contract 30 days from now, that quote I gave you today was only good for today, and actually at that time, rates could have changed. I mean, the market is subject to change at any time without notice, unfortunately, but 30 days from now, it's going to be a very different situation, right? So if you're only calling to get a pre-approval from lenders shopping based on rate, you're doing yourself a disservice, because anyone who's quoting lower than normal rates just to get you in the door is actually just trying to get you in the door. They're not being honest and forthcoming with what they're doing. So you want to make sure that you're getting everything in writing as well. They should be able to give you, if someone's going to issue you a pre-approval, like for me, when I issue pre-approvals to people, I also give them a summary of their costs, what all the costs are going to be, the lender fees, the attorney fees, the title, all the fees involved, along with their mortgage payment, their maximum payment, what that looks like based on taxes, insurance, and all that. So I will always send a summary. Some loan officers won't. I always do. Again, it'll say in there that the rate is not locked because it can't be. But just so you know, if that's the only way you're shopping for pre-approvals for rates, that's really not, you're not really helping yourself in that situation.
Awesome. Well said. And I think you really touched base on something really, really important. There are many lenders, they'll say whatever they want to say to you just to get you in the door. Mm-hmm. So keep that in mind. What documents should buyers have ready before applying?
So you want to have your most recent 2 years of W-2 forms if you're a W-2 employee, and you want to have at least 1 to 2 pay stubs, recent pay stubs, okay, and current bank statements, so we can see your bank statements. And then if there's any other unique, if you pay maintenance or child support, we need to see the divorce decree, the court order, that kind of stuff. If you're collecting child support or maintenance, we need to get 6 months verification of your bank statements that you're receiving. So it's something that as we go through, so for me, I'll ask people for their W-2s and pay stubs up front, and their bank statements. But then when I'm reviewing the loan, I could see that they have bonus income, or they have a second job that has, it's self-employment income or whatever. So then I'll call them back and say, hey, Jay, this is Social Security. Oh, it looks like you get Social Security. I'm going to need your awards letter. Oh, you're self-employed. I need your 2 years tax return. So, and that's part of it, right? Is that you can't just assume you're only using one part of your life. If you have other parts of your life, for example, if you're doing an FHA or a VA loan and you have Schedule C income, even if it's not being used. So let's use an example of someone who works in an office as a W-2 employee and then maybe drives Uber, as a part-time job. But with a self-employed person, a Schedule C means you get to write off expenses. So even though you made $50,000 on 1099 with Uber, you wrote off $55,000 in expenses. So ultimately your Schedule C is a negative $5,000. So this goes back to me saying that you might feel like you can afford it. In real life, you have your salary plus your Uber money, but you only show the government, you showed the government negative money in that situation I just gave you. So now that negative $5,000 on an FHA or VA loan actually comes off your salary. So if you're not giving all that paperwork and it comes up somewhere that during the process, that could potentially kill your deal, especially if your debt to income ratio is pretty close. Now they find out during underwriting you have this loss and now you don't qualify anymore. Again, devil's in the detail.
Let's switch gears a little bit here. Let's talk about interest rates. Interest rates are in the news. They're going up, they're going down. People are just confused. People are saying they want to wait. People are saying, oh, maybe I should move now. What's your take on that?
My take is if you're ready, you do it. If you can afford it, you do it. It's your decision. It's a personal decision. It shouldn't be made by the news, social media, your family, your friends, your coworkers. Yes. It's your situation. And if you feel that you're ready to buy a home and you've gotten all the information that you need, then you're ready to buy a home. If you're not, you find out how and when you may be ready. So that's my take on it.
So if you see it, you love it, move forward with it, people. Mm-hmm. How do interest rates affect the buyer's monthly payment?
So obviously there's an APR, which is, the interest that you pay over the life of the loan, which in most cases is 30 years. And then there's the actual interest rate, which is locking in the principal and interest, the monthly payment of the principal and interest. So on a 30-year fixed loan, the principal and interest, if the payment is $1,500, that $1,500 stays $1,500 for 30 years. And it's locked based on the interest rate and the loan amount you had at the beginning. The APR is the interest you pay over the life of the loan. So in reality, even though you have a 7% interest rate and your $1,500 is principal and interest, if you're making those extra payments towards principal, and that could be anything, monthly, quarterly, annually, anything you want putting extra, you're actually lowering the amount of interest that you pay without having to lower your actual interest rate. The reality is instead of paying $200,000 in interest, maybe now you're only paying $150,000 in interest. So the rate stays the same, but how much interest you pay is actually, most people don't know this, we have control over that based on how we make our payments.
Can a buyer actually lower their interest rate? And can a buyer buy points?
So those are the same thing. So if the rate today at par, so we can all say par is 0, right? So par is no overage, no underage, if you're a golf person. So par is 7%. Let's just make up a number right now. And you decided you wanted your rate to be 6.5. So 6.5 is below par, which means there's going to be a gap here that you have to make up the difference because the lender's getting it at 7%. You want it below market. So if you're paying points, you're basically covering that gap from 7% to 6.5% in the term called points, which is ultimately the interest. It's like prepaid interest up front. So you're taking a big pile of money. You're putting your big pile of money here, okay, up front. You paid your lender up front. And then I would hope you're asking your loan officer, what's the difference between 7% and 6.5% monthly? Because if it's a $50 difference, but you had to put up $10,000 up front, you might not think it's worth it to save $50 to put $10,000 up front because there's a break-even point. The break-even point is, here's your big pile of money. Every month you're making your mortgage payments. That $50 comes out of the pile, so the pile starts to shrink. However, if a year from now the rates come down to 5%, and you decide you want to refinance, because who's not going to refinance when they come down, your big pile of money blows away, it goes away. You never get it back. It's not yours. You never made it to your break-even point, because your break-even point is typically 7+ years, because you refinanced it a year later. How hard is it to make that $10,000 that you saved $50 a month? Sadly, a lot of loan officers don't explain that to people, and I'll tell you one little secret. When you're a buyer, when you call and say, give me your lowest rate, they're giving you the lowest rate. They just might not always be telling you that you're paying for it. And you have to be cognizant when you're looking, again, asking for fees, because sometimes they won't call it points. They'll call it loan level price adjustments, or they'll call it a origination or whatever. And as Jay and I were talking the other day, I said, I could call this a thingamajigger, or I could call it a thingamabobber, but you're still paying the money. Whatever it's called, you're still paying it. So be aware of that, because that's a lot of money for you to lose just to save that little bit of money each month. So be cognizant of that.
Every once in a while, people become surprised when we discuss closing costs. They save for the down payment, but they're not fully educated on the other closing costs. What can you tell us about that?
Yes, this is definitely one of those fun topics. Down payment is a percentage of the loan, right? That's your money that you have to put down. The closing cost is a combination of lender fees, title fees, recording fees, appraiser, attorney. If you're buying in certain neighborhoods, there's transfer taxes, the credit reports, there's, and then if you're buying points, which we talked about points in a previous segment, those are all closing costs. And when you're shopping lenders, you want to know, so if I'm shopping lender A and lender B, you want to know, you ask lender A, what is your lender fee, and are there points attached to my interest rate that you're quoting me? And then you have to ask lender B the same question, because lender A, if lender A is telling you their lender fee is 60, like I'm gonna give you an example. Our lender fee is $1,640. So we have 3 fees that total $1,640. You could go to lender B and their lender fee is $2,300. They're already higher just in lender fees. However, when I'm quoting my loans, I'm making sure that people are knowing all of it. Like, for example, everything else is third party. Let me just say this. Everything else is third party. So regardless if you use lender A or lender B, their fees are their fees. All the other third party, those transfer taxes, the title, the recording, the appraiser, all that, those are third party. Those are not lender fees. Those are going to be the same. The title fees are going to be the same regardless if you use lender A or lender B. It doesn't matter. The fees to the town of Naperville are going to be the same regardless of the attorney fee, whoever. All those fees are going to be charged the same regardless of who the lenders are. So when you're shopping lenders, you ask the 2 questions. What is your lender fee? Not what are your closing costs. Because when you're asking what the closing costs are, that's a culmination of everybody's fees. So when someone asks me what are the average closing costs, when I say everybody included, appraiser, title, lender, everybody, and I say it's $8,000 or whatever, somebody else might come in at $6,000, but that's because they quoted the title fees less. Some out-of-state lenders our titles are fairly expensive here in Illinois, and the majority is anywhere from $4,000 plus. And so, like, I usually have about $400 to $4,500 on my estimates, because again, we don't know, it's not our fee. There might be another lender who has $3,500. So their closing costs look lower than mine, but they can't lower a closing cost that doesn't belong to them. So that's why it's important when you're shopping lenders, you ask them how many points are involved in this interest rate, because that's also the other part of it, right? Because the points are considered part of the closing cost. And also, is the rate being fairly, if this loan officer quotes it at par and this loan officer is quoting it with 2 points, the rates are not going to be the same, but neither are the fees. And if you're not asking, you only heard the interest rate, but you didn't realize you paid extra. So you want to pay attention. So what is your lender fee, and are there points associated with my interest rate? Those are the 2 when you're shopping. The rest of it you're going to have regardless.
Can a buyer negotiate receiving assistance with closing costs?
Yes. So the closing costs actually could be paid by the seller There's going to be different percentages based on the type of loan they're doing and how much they're putting down and things like that. The amount of the credit can never exceed the amount of the actual costs. The seller can never pay the down payment. So the down payment, regardless of a buyer's always coming up with their down payment. On a closing cost side, that would be up to the realtor to be able to negotiate the closing cost credit when you're doing the negotiations on the price. That would be your realtor. The seller is not required to do a closing cost credit, so you can ask for it, but they're not required. As a lender, we are able to give a lender credit. However, back in 2010, the rule, Dodd-Frank rule, came up after the market crashed, and loan officers are not allowed to make any more or any less on a deal, which means if you're trying to get a closing cost credit from your lender, we have to charge you a higher interest rate to give you the credit. So if you're at par here for 7% and you want me to give you a $5,000 closing cost credit, I have to go higher in interest rate, and all that overage up here is credited to you as a lender credit. But the only way to do that is for you to pay the higher interest rate. So we always try to do seller credit. As far as the down payment, the only way you can have the down payment paid for by anyone other than yourself is if you're using like a down payment assistance program. Otherwise, the buyer always has to come up with their down payment.
Okay, well said. The buyer always has to come up with their down payment. So don't rely on the sellers too much. But the lenders will try to do what they can. Taxes and escrow. Now, since we're in Illinois, property taxes can be quite a bit. How does that affect the buyer's monthly payment?
Yeah, this is one of my favorite topics. So the taxes, as I tell my clients, are all over the board. There's no rhyme or reason. Unless you live in like a condominium townhome neighborhood where everybody pretty much has the same home, everyone pretty close to the same square footage and all that, it's gonna have the same taxes. Otherwise, this part of the neighborhood, the taxes are higher. This part of the neighborhood, they're a little bit lower. Is it the school district? So if you're in a higher school district, you're gonna have higher taxes, right? So a lot of people that wanna live in the better school districts are gonna pay higher taxes. Unincorporated areas in a town, in a neighborhood, where you're not paying local police, the county are your police, right? So you don't have a lot of those same, so the taxes might be a little bit lower in unincorporated. So when I'm pre-qualifying people, you can't just say, here's your pre-approval for $400,000, 3% down, go buy a house. And the reason, I buy in Plainfield, $400,000 property, the taxes are $12,000 a year. Take $12,000 divided by 12, that's $1,000 a month for taxes on this $400,000 house. But then I go to Joliet, and Joliet has a $400,000 house, and the taxes are only $8,400 a year. Take $8,400 divided by 12, I'm using easy math, 84 for me. That's $700 a month, right? So the payment in Joliet's going to be $300 less right out the gate. Same price, same interest rate, same insurance, same everything else with the exception of the taxes. So you can't get a pre-approval that says go buy something for $400,000 without knowing what the maximum amount of those taxes are. So when I send a pre-approval, I'll say, Jay, your max is $450,000 as long as your property taxes do not exceed $10,000. So if you find a property and the taxes are $13,000, you're not buying the house for $450,000 because you're already $3,000 over what I told you the max was. So you can't just think property price. It has to be, those taxes are a huge, huge piece of the puzzle. And that it affects your debt to income ratio. So just in that example alone, that's a $300 difference for the same priced house.
Yes.
So I want that to resonate with people. I don't think people really get that part.
Yes,
So,
well said.
yeah.
So even if you're pre-approved, regardless of location and the taxes, the tax rate of that particular property is going to make a huge difference in your debt to income ratio.
And if I may make a suggestion, make sure that you're making those monthly payments calculations before you go look at the house, because a lot of times people also don't understand. If you don't already know like what your range is, you might not even understand what that looks like. And when you see the actual the mortgage payment's going to be $4,000, you might not want to go look at it, because if you go look at it and fall in love with it, and then you go find out your payment is $4,000, you might not be happy with yourself. You're going to be happy with anybody because you didn't want a $4,000. So know what your payment is beforehand. And then also one other thing I do want to comment on, because you qualify for a certain amount on paper doesn't mean that's how much you want to spend in your monthly budget. And I always ask my buyers, what's your realistic monthly budget compared to what you can afford on paper? So we'll give you your pre-approval on paper so that you have that ability to go higher if you wanted to, but at least you know what your ceiling is on paper, but it's completely up to you how much you want to spend every month on your property.
This is why it's important to choose the right lender. So what exactly is an escrow account, and do lenders collect taxes and insurance monthly?
So yes, if you're doing an FHA or VA loan, we're going to be collecting the taxes and insurance on a monthly basis, and then annually. The insurance is paid annually out of your escrow account, and the taxes twice a year. Conventional, if you're putting 20% or more down, you actually have the option to not have an escrow account and pay your own taxes and insurance. If you're putting less than 20%, you don't have the option, and you would also have to escrow where your taxes and insurance will be part of the monthly payment. One other thing I want to bring up that I bring up to my buyers is, if you're already maxed at your payment when you're purchasing, the taxes and insurance are going to go up every year, even if it's $100, $5 a month, whatever. So if you're already maxing yourself out at the time you're getting pre-approved, you have to remember going into the next year that your taxes and insurance are going to increase, which means your mortgage payment's going to increase. So you have to be prepared for that as well.
Hey, Tina, you have been awesome. Now let's go to the lightning round.
Oh boy.
What is the biggest myth in mortgages?
How about your credit score on Credit Karma is going to be the same credit score we get on the mortgage side? Wrong.
Wrong. Don't fall for it, people. And don't fall for Uncle TikTok either.
No, do not get your mortgage advice on TikTok.
So what would you say is the biggest mistake first-time home buyers make?
I think, unfortunately, they overbuy because they get excited about it. Instead of starting with a starter home, they go straight to the Taj Mahal, and they figure out that they can't go on vacation, they can't do other things because they're a little bit more house poor now because everything was much higher than they thought it was going to be.
So let's cool things down a little bit. Coffee or tea?
Next.
All right, fair enough.
These teeth don't stay white with coffee and tea.
What is the best advice that you can give someone hoping to buy within the next year?
So what I like to tell people is, if you're currently making rental payments, let's say of $2,000 a month, and you know that you're going to be purchasing next year, and you're started a savings maybe, or you're about to start a savings, I always encourage people to open a larger, like right now, certain banks are offering a 3% interest rate, let's say, on a savings account or whatever. So you open it, you put in your starter money in there, and then knowing that your mortgage payment is probably going to be higher than your rental payment, get yourself prepared to make those higher payments. So you're doing two things at the same time. If you're currently paying $2,000 and you think you're going to maybe go $2,500 in your budget, let's say, in a mortgage, you would take $500 a month and put it into that savings account for the savings, but you also became accustomed to paying out $2,500 a month and adjusting your lifestyle prior to buying the house. That way you have a better understanding. It also may help you curb some of your spending. So maybe you're not using as much of your credit cards because you know you're trying to put the money. It's a mindset. So if you're trying to do that, some people say, I want to pay down my debt. And you can, but you have to actually pay it down. Paying it down isn't paying your minimum payments. You have to put chunks towards it and whatnot. So, again, there's great advice, but not all advice is for everyone. You have to be specific. When I talk to people, I talk to them and let them know it is not cookie cutter. We all have a different situation. We all have different end goals. We all have different financial goals, or, and handle things in different ways. Like me personally, I'm someone who says, I have enough money to put 20% down, but I would never put 20% down. I will let the bank take over the money, and I will gladly make the payments so that I can sit on my nest egg. But I'm also an older person who, sees it. A lot of older people wanted to do 20% down because that's the way it always was done. We don't have that. That's not necessarily the way it has to be now. So for me, I like having my money more liquid. Sit with someone else, they're going to tell you I'm wrong, I don't want to pay PMI, and I'm okay with that, whatever their situation is. It's not for me. They're the ones, and they always stress, you're the ones making the payments. You tell me, do you want money in the bank? Do you want to live check to check? Because unfortunately, that is another thing. They save their money for the down payment and their closing costs and everything else, and then they buy it, and then now they've got nothing left. And now they start living on credit cards. And I tell you, a lot of times, a year later, I'll get calls where they went and bought furniture and towels and, everything for the house and dishes and all this. And now they've got, these 29% interest rates and all these credit cards. And now they're like, should I do a home equity? Can you help me? And I hate to see it. So we talk about that up front. But again, I think it's who's talking to you, where are you getting your advice, and again, it's great that Uncle Joe wants to help you and your mom and dad and everyone, but it's ultimately your decision to make. You're the one making the payments on the house.
Tina, thank you so much for sharing your expertise. And hopefully this answers many of the questions that buyers may be wondering when they're starting their home buying journey. If you'd like to connect with Tina regarding financing, or if you'd like to talk with me about finding the right home, feel free to reach out to us. Okay, so there you have it. Wise words from a wise woman. VP of Mortgage Lending, or should I say BIP of Mortgage Lending, Tina Apicola. Now, if you really want to dive deeper into this, there is a great find on Amazon. Tina has her book.
Yes, home buying, the stuff you could have learned if calculus wasn't a subject. An easy read on a boring subject. It really is just a little easy read for people. I do send a copy when I'm working with clients. I always ask everyone ahead of time if they like to read. No judgment if they don't, but if they do, I like to send a copy. And I love when I get texts of highlighters and all kinds of things that people learned in the book. So if you're interested, and it's very affordable if you don't work with me, it's only $7 on Amazon. So wanted to make sure everyone had access to the information.
You know what? That is the best thing that you could have said right there. She wants to make sure everyone has access to the information, regardless if you work with her or not. You can't go wrong with that. And the book is only $7. The information is there, people. Well, if you enjoyed this episode of Friends of Franklin, drop a comment below on what subject we should cover next. Tina, it has been an absolute pleasure, and thank you.
Thank you so much for having me.
Outstanding.